Ladies and gentlemen, welcome back to the channel. It looks like big tech might be starting to finally give up. You could contribute this to a rally that has just went far too fast, far too quickly. You could also contribute this to the debt ceiling and the lack of progress it looks like we're going to get on the debt ceiling. And coming at 3 o'clock today, so like right around the corner, you're going to be getting some information, right? 3 o'clock, 4 o'clock, 5 o'clock, in those hours, you're going to get an update from the House Rules Committee. And we'll know if we will be able to bring this debt ceiling deal to the floor. But some of these key Republicans that are part of this Rules Committee are opposing this and outright saying that this should not go to the floor. A big one is Chip Roy, a Republican from Texas. He is outright, bashing this bill publicly. And I was just watching it, and they've been speaking for a while now. So we'll see what happens with that. Markets are giving it up. Big tech starting to give it up just a little bit here today. So let's kind of get into what's happening in the markets right now. I know we focus on AMC. I know we focus on that a lot, and we will in this video as well, but I do want to talk about what's happening on a broad picture basis, because we've talked about this many times, but when stocks do fall, big tech stocks that have all of the money essentially in them, the collateral that is behind AMC short positions, that can be equally, if not more important than an actual positive catalyst for AMC to get a short squeeze. Let's get into it, ladies and gentlemen. Hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comments section. So first things first I want to get into is this from David Rosenberg. He says a price bubble in AI stocks will wreck the rally. He predicts, and he says this is like the 1990s .com bubble. And I think this is a bubble as well. I mean, it's pretty obvious. If a company just mentions AI in their earnings report, they are 150% more likely to go up rather than down, even if they have bad earnings. Statistically speaking, maybe it's the algos, maybe it's AI investors, but someone somewhere is buying AI just off of a mention of AI. It doesn't even matter if that business has nothing to do with AI. People are buying it up. And this has driven Nvidia to now cross over the $1 trillion market cap for the first time in history. Nvidia has never been a $1 trillion company. Well, now it is, at least for the time being of the day today, it was. If we go ahead and look at Nvidia is still up almost 3%, guys, so keep that in mind, but is flushing into the lows right now as we currently speak. So I think the debt limit is going to be massively important. If you do get the House Rules Committee that does not let this go to a vote on the floor, you're going to get some downside in the markets. Now, small and mid-cap stocks, they've already crashed. We've talked about that before. They have already crashed. That's a well-known fact. So the capital's not allocated to those names. It's allocated to the top names in the markets. And those top names in the market are obviously your big tech stocks. And what we've seen from big tech stocks is just a parabolic rally. I mean, if you look at the NASDAQ, it's been just straight up. It's just like a meme stock, right? This is driven by AI. Now, if you look at the NASDAQ on a weekly chart, every time the NASDAQ has gotten overbought on the weekly RSI, it has fallen. Last time you were overbought on the weekly RSI was back here, November 19th, 2021. The NASDAQ returned 2.35% that week. The next week, you actually hit a new high, and that was in the beginning of the week. And then you closed down 3% for that next following week. And basically, same story across the board, even to a smaller extent right here. September 3rd, 2021. You got overbought on the RSI for a week, and then you came down, right? And the next following weeks were pretty red. The next week was a 4% down week. Back here before COVID, same thing. Overbought on the RSI, COVID crash. Same thing back here. Overbought, crash. Overbought, crash. History just plays out the same way. So we could be on the doorstep of seeing another leg down in the markets. Now, why is this specifically this time around so much more important than I really think a lot of people fully understand? Well, number one, when you make a short position, you got to put up collateral. You got to put up money for that short position, because a short position can go against you to infinity unless you're hedging that out. And when that's the case, banks, institutions, whoever is lending out stock doesn't want to get screwed. They don't want to be in limbo where the short seller can no longer buy back their shares and they just don't have shares anymore. They're not going to let that happen. So you got to place collateral. Now, with AMC and GME, only high quality collateral can be placed for AMC short positions. That leaves your 5 to 10 largest companies in the markets that are eligible for the collateral requirements on AMC stock. When these stocks do start to roll over, in which it looks like you're seeing a little bit of that here today, that becomes a big problem for hedge funds and institutions. Now, the short interest has recently fallen on AMC stock, down from 26%, almost 27%, to about 21%. A lot of the shorting you're seeing is actually with the options. So when you're seeing this shorting with the options, it's non-discretionary short covering. And what I mean by that is, like I said in the last video, and I understand. I'm going to repeat it in this video so everyone can fully understand this. If you're a hedge fund, an individual, anyone, and you take out a short position, if that short position goes against you, as long as you have the collateral and the capital necessary to pledge, additional capital to your short position, you can remain in that short position. Nobody's going to come in and really force you out unless something really bad were to happen, right? So it's discretionary covering. Non-discretionary covering is like we could see very shortly. Market makers, they go out and they hedge, right? The job of a market maker is not to be an evil entity. It's to be a source of liquidity, right? Because odds are most of the time you're buying options, about 95% of the time you are buying an option, there is not someone or some hedge fund to sell you that option. Sometimes there's too much risk involved with doing that. So what market makers do with their massive liquidity pools is they will go out and make a market, meaning they will go out and sell you the puts, sell you the calls. And when that happens, market makers, they have to go out and hedge. So a lot of these institutions have been buying those deep in the money AMC puts, those $10, $13 puts. And when the stock is going down, that's all fine and dandy for these buyers of these puts. Market makers keep shorting stock. But when AMC does ultimately start to rally, that's where you get the non-discretionary short covering, because market makers, they're sitting on probably about 65 million shares that are short of AMC right now. If AMC does start to rally, they're not in this to lose money. They have to go out and buy AMC stock. And when you're looking at that many shares that market makers potentially would have to buy back, that's a problem for hedge funds. That's very bullish for AMC. And how I'm getting to 65 million shares is basically adding up the in-the-money contracts from now until July 21st. A lot of these have already been hedged for because the stock's been falling, right? AMC stock's been falling, so they have to hedge out these positions. So 65 million shares potentially being bought back by market makers, that's a pretty dang big deal. Now, if we look at kind of things that are currently happening in the markets, the breadth is terrible. Terrible in the markets. The NASDAQ goes higher. Average stock in the NASDAQ continues to go lower along the lines of, we're seeing collateral and capital really being concentrated into these very, very large names. Now, also, the Chinese yuan, every time this thing gets above 7, you have seen a problem in the markets. You have seen a crisis of some sort. Back here, 2016, above 7, crisis, plummets. 2018, above 7, crisis, plummets. 2019, when you were getting the rate cuts by the end of the year and the markets fell, crisis, above 7. Before COVID, above 7, crisis. Back here in October 2022, I mean, it started to really rally in August, signaling a potential crisis was coming. And then stocks, obviously American stocks, fell and hit their lows. Well, you fell down to about 6.69 wands per $1. Now you're back up above 7, signaling that another crisis might be to come. Maybe it's the debt ceiling, maybe it's other things. Who knows? But I'll tell you right now, we got a problem. At the same time as all of this, the M2 money supply is starting to fall again. Basically on a month-over-month basis, falling hundreds of millions of dollars. Billions of dollars. And this is not good for the markets. Typically, as you can see from this chart, money supply increasing usually leads to stocks going higher. This roughly looks like a chart of the S&P 500 if you were to overlay them. Well, you've seen this come down and the money supply has not picked up. So throughout the banking crisis, throughout the Fed increasing the balance sheet, money supply still shrinking. This should be leading to downside in the markets, not the markets almost at new all-time highs and specific stocks well past their all-time highs, such as Nvidia. On top of that, some data we got today from Dallas Fed Manufacturing came in very contractionary as well. You got a negative 29.1 reading. The forecast was for a negative 25 reading. This is the worst reading over the last 5 years that you have seen with the Dallas Fed Manufacturing Index. At the same time, the S&P Case-Shiller home price month over month came in at 1.1%. You were expecting a 0.3%. This is the first increase that you have seen since June of 2022, about 1 year ago. So you're getting bad economic data, lots of concentration in the markets, bad inflation data, the Fed's that's going to raise rates. Who knows if the debt ceiling is going to be resolved? These things don't look very good for the markets. That makes me very bullish about this trade currently on AMC stock, on liquidity here in the markets. So just taking a bird's eye view at these things, it's a good time to be long in AMC in my personal opinion. Especially now GME is going to be reporting earnings this week. That's also going to make things very interesting. If GME reports good earnings, that's likely to create a good reaction as well, and none other than AMC stock. So that is going to do it here in this video. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.